illustrates the hypothetical growth of a $1 investment after considering the effects of both taxes and inflation on each asset class over the past 85 years. Of the asset classes considered, stocks is the only asset class that provided significant growth in spite of taxes and inflation. Municipal bonds, for which income is exempt from federal income taxes, barely provided enough total return to offset inflation. Government bonds closely kept pace with inflation. Treasury bills, however, fared the worst. After considering taxes and inflation, the initial $1 was reduced to approximately 54 cents. So, if you want to overcome the effects of taxes and inflation, consider a larger allocation to stocks or tax-deferred investment vehicles. Intuitively, you know that taxes reduce the earnings you retain. This chart illustrates how much the federal government withheld from one hypothetical investor who was following a simple long-term investment strategy. The returns for the stocks column are after taxes and assume that the stocks purchased were held for 5 years, sold, and then the capital gains were realized. The net proceeds from the sale were reinvested. Dividends were taxed when earned and reinvested. From 1926 to 2010, the average return on stocks after taxes was 7.8% compared to 9.9% before taxes. Bonds were turned over 27 times within the 85 years. Capital gains were realized on the sale of reinvestment. Bonds averaged 3.4%. After taxes, on over this period, cash earned an average of 2.2% after taxes compared to 3.6% before taxes. Comparing the after-tax return to the rate of inflation, you can see that if you invested solely in cash equivalents, you actually lost money in terms of purchasing individual retirement accounts or IRAs, company-sponsored 401k plans, 403b plans, KEO plans, and tax-deferred annuities. Talk to a professional investment advisor to learn more about the differences among these tax-deferred investment vehicles, and to your employer to learn about the plans it sponsors. This graph illustrates how deferring taxes can increase the value of an investment over time. Let's say, for example, $10,000 is invested in both a taxable and tax-deferred account. The difference is fairly modest after 20